Good afternoon. This is Joe Pryor with virtualrealestateteam.com in Oklahoma City. This is the second in the series that I'm doing on investing in real estate. And I've done this before, but it's always good to review certain things like this again. In the first video, we talked about, in general, about Oklahoma City, why it was a good market to invest in, why it's a very stable market, prices are holding, the economy is good, lowest unemployment rate in the United States, and the lowest amount of underwater mortgages in the United States. And we'll probably do another video on some of the things that are really exciting here in Oklahoma City. Hopefully tonight the Oklahoma City Thunder can beat the Dallas Mavericks. That would make it even more exciting. But today what I'd like to do is focus on three terms that you should hear a lot if you're talking to people like me that specialize in real estate investment or investment in general. The first term I think is important for you to know is what's called IRR, Internal Rate of Return. What this is this gives you an annualized percentage of what your investment in real estate is yielding over the course of the investment. Now, it is a long-term investment statistic, and there are some suppositions, some educated guesses and things that go into it. So anytime anyone computes internal rate of return, it should be a very conservative computation. One of the things, of course, is we start out with purchase price, but not just the purchase price, but the value of the property. Let's say you got a heck of a deal on it with a short sale. The house is worth $150,000, but you bought it at $110,000. This is going to affect your long-term investment because you're starting out on paper with $40,000 in equity. That's number one. The second is, how long are you really going to own that property? Now, most of the investors in Oklahoma City are long-term investors, and so they're going to own the property from about 5 to 10 years, let's say, before they resell it. Most investors that are long-term investors are going to sell that property and do what's called a 1031 tax-deferred exchange to move on to another property and not have to pay capital gains or recapture tax on the depreciation, something we'll go into in another video. Then also we're talking about vacancy rate. We're talking about expected rental. What the property management fee is going to be, what the taxes and insurance are. If you are making positive cash flow, which you invest in Oklahoma City, you will be, what are you going to do as a reinvestment rate? Are you going to stick it in a 2% investment or a 4% investment that's safe? What are you going to do with the money that you make? And then at the end of that time, that 5 years, 7, 10 years, what are you going to do with the property? Are you going to resell it and cash out, or are you going to do the 1031 and defer your taxes into the next investment? And so we're going to give you a pre-tax and a after-tax number so that you can compare it to a mutual fund or long-term stock market, whatever it happens to be that you're trying to compare it against. Now, normally your pre-tax profits, if you buy right, are going to be in the 20s, maybe even in the 30s in some markets and at some times. So if you're over a 7-year, if the supposition is get a 25% return on investment before tax, then you can say, okay, that's a safer investment looking at risk versus something else, and I really like that return, and it is something that is bricks and mortar, is tangible, I can control. So those are all the things that you put together on that. Now, things may change. Rents may go up and down. Taxes and insurance may go up and down. A lot of things can change. And so, again, it is a long-term analysis of what we think is going to happen. Now, there's two other terms that are used primarily in commercial but are creeping in and probably really good to use in residential investment, and that is capitalization rate and also cash on cash. The reason why I say they've been used in commercial is much more dependent on rents as how that affects the ultimate value of the product, whereas in residential, we're talking about a combination of rents and, of course, house appreciation is being driven not by the investor but by other owner-occupants around it. So what we do in a capitalization rate is we take your purchase price, let's say it's $110,000, we take and analyze what your net operating income, which is obviously going to be less. So if it's $110,000 and you have $11,000 net after you pay all the expenses that we're talking about, and this is before you actually pay any kind of debt service, then we say you have a 10 cap or a 10% capitalization rate, kind of a magic number. And in most cases in Oklahoma City, we can get you close to that. Doesn't necessarily mean that you should or shouldn't do things, but a lot of times that triggers an investor to buy if they know they have a 10% cap rate. So it is a method of saying, this is what I ultimately paid for the product, or for the home or the property, and this is after expenses and before I pay my debt service, what I netted on the property, and the difference is in a percentage. And that is a snapshot. If IRR, total rate of return over 7 years, is a long term, this is a snapshot of the first year. So it's like comparing a video to a picture. So this video is like IRR, but if I showed you a picture of me and it was static, it would be like that capitalization rate. Now finally is what's called cash on cash. And I like cash on cash because it's a return of investment instead of on investment. Those first two are return of investment. In other words, based on the purchase price or the money that I put in, this is what ultimately I'm yielding on that investment as long as the money stays there. Cash on cash is a different thing. It is a situation where we take the amount of money you actually put out. In other words, that may be $25,000, for instance. Let's say it was $25,000. And then we find out what your net is now within that first year, and we compare that to the cash that you actually put into the investment, because the rest is what we call leverage. You put this amount of cash out, the rest was financed over a long term. And the cash on cash is a snapshot of how much money that we put out that we're getting back in that first year. So in this particular example of that $110,000 house that has a 25% internal rate of return and a 9.67% cap rate, then we're talking roughly about 18 to 19% of that $25,000 we're actually getting back in the first year. So based on a good market, appreciation, maybe rents going up, we might be able to say ourselves, well, to ourselves that in 5 years, I might be able to get all of my $25,000 back. I may be keeping that house for 10 years, but I paid off my investment in 5. And so everything else, that positive cash flow, is just pure gravy. So anytime that we're dealing with you on an investment in the Oklahoma City market, we're going to be analyzing these three terms. Now, if you want me to get pretty sophisticated, I can get pretty sophisticated. I've been in this business for 21 years. 18 years is something that has been a specialty for me in terms of investment property. I do have all sorts of computers that, or software, computations that allow me to really flexibly analyze your investment. If we want to make some changes in the second year, the third year, the fourth year, whatever, we can do that for you if you want to get that detailed. I think the most important thing that we're looking at is, A, what is the ultimate value of the product that I'm buying? In other words, if that house is worth $150, I'm getting it at $110, and $150 is really the appraised value, then, okay, that's a real number of $40,000. If I know that I'm getting $7,000 or $10,000 in terms of net operating income from that property, those are real dollars. If I know someone is paying off my investment, I know those real dollars. So those are the important high points in those three terms that we really want to hit with you. But if you want more, we'll be glad to give you more. We want to make sure that whatever investment that you make, you're totally confident in terms of what you're doing. And the thing about investment property, it's all numbers. It is not a subjective criteria. It is objective numbers that we analyze. And so it's a very clean look. And the look that we're going to give you is, say, based on my return, based on how I analyze real estate investment in terms of risk, I like this more or less versus something else. Now, we'll be going into more detail about different aspects of real estate investment in Oklahoma City, and of course this is basically anywhere in the future videos. Until then, this is Joe Pryor with virtualrealestateteam.com, where we deliver traditional real estate values with the speed of technology.